Now let's look at the capital cost allowance. As I said, this applies to Canadian tax law only. Capital cost allowance is essentially depreciation for tax purposes. So the government is not going to let you pick your own depreciation rate because it'll allow you to play around with your taxes payable. So they don't want to do that. They'll tell you what the depreciation rate that is acceptable is for each type of asset, like a truck, a machine, and that's called the CCA rate. Okay, and this is a big formula that you should all have on your formula sheets. Okay, so the present value of the CCA tax shield is as follows. Okay, so it's this formula, and the variables are: C is the cost of an asset, D is the CCA rate. So let me put down, this would be in dollar terms, CCA rate is in percentage, the tax rate is in percentage, and the discount rate is in percentage as well. All of that will be given. Salvage value is if there happens to be any resale value at the end of the life of the asset. That's in dollar terms. And N is a number of years. So what is this formula telling us? It is telling us the total value of all of the tax savings you'll get by owning this asset, converted into today's dollars. So the total value of future CCA, future tax savings from owning the asset. And the reason you get some tax savings is because the government's going to allow you to write off the depreciation for tax purposes. So your taxes will go down. The amount is different every year. And the other thing you're going to be doing is it's going to be discounted for time value of money. So rather than calculating each year, discounting it all back, you can plug it into this formula and the answer will be, this is the total savings you get from buying this asset. So if you bought a $100,000 asset, to keep it really simple, and you ended up getting tax savings, this PV of the CCA was $25,000, then really the asset cost you $75,000. You paid the 100 and you're going to get $25,000 in savings over life. Now, why did I put this in 0.5 in red? The reason is because the tax laws have changed. Okay, so prior to 2018, only 50% was deductible in the first year. Because the government assumes you could have bought the asset on the last day of the year, which you held it for one day, or you could have bought it halfway through. So they just took 50%. So that's why we got the 0.5 up there. And then in 2019 to 2024, they increased it to 150%. Okay, so therefore, the 0.5 would change to 1.5. And why did they do that? They basically were trying to give an incentive to invest in Canada, so they gave you a larger tax break. And after 24, it returns, and depending on the asset class, it could be 0.5 or it could be 1.0 or whatever. In the case of your exam, you'll be told what the number is. The reason I'm mentioning this is because if you look at an older version of the textbook, they may use 0.5. And if you look at a more recent version, they'll use 1.5. And it can get confusing. So the formula here is the same. You just change that number based on the first year depreciation rate, and that'll be given to you in the question.